It is Thursday, February 4th, 2021. This is the Real Vision Daily Briefing. I'm Ed Harrison, joined by the CIO of Muddy Waters Capital. Thank you very much, Carson Block.
Thanks, Ed. Good to be here.
So, you and I, we spoke yesterday. I could talk to you for like hours about many different topics, I have to tell you. But I want to start this out sort of from a broad perspective. Just as an introduction, Muddy Waters, people know you because you're an activist short seller. You're looking at financial frauds in particular. And in order to do that, I think, the economic backdrop, the macro backdrop, I think is important in certain aspects. That's why I want to start broad. And let me paint the picture for you, and you can give me some pushback and tell me how you think about the picture. This is how I'm thinking of it. We're in the middle of a mania right now. One of my colleagues was just telling me about GameStop down another 35% today. That's one of the loci of the mania. And the backdrop more broadly, even still, is that this is happening under an atomization of media, an implosion of the traditional media, especially in terms of long-form investigative side of things. So really, there's a vacuum that's being filled by social media, and a lot of people are just grabbing onto sound bites. We're reducing complexity in a situation where financialization has run amok and the complexity in the financial system has run amok. And that's all happening simultaneously as we're locked down. I'm talking to you from my basement during a pandemic. So that's the macro backdrop that I see. And I look at that as one in which financial fraud can happen very much.
Mm-hmm. Yeah. Well, I want to break down what we do into two different buckets. So there is, from the legal perspective, fraud. So that's where a company has crossed the line and can be held liable for fraud. But then there's also this other bucket, which is actually more of what we do, which is intellectually fraudulent. It violates the spirit of the laws, but they stay generally within the letter of the law. And by stretching accounting standards, relying on safe harbor statements to exculpate them from liability. And I feel like that's actually a more insidious problem. Where you get these frauds, especially these frauds from emerging markets that are almost total empty boxes, those are egregious in terms of reality versus what they want the perception to be. But when you look at this legal fraud, it's really symptomatic of a larger problem in our society that has existed but grown for decades, which I call it the tick the box apocalypse. So you can bend truth, you get enough lawyers in, to create these checklists, you check them off, enough papers, you've got plausible deniability, and hey, everything is done legally. And the reality is that with where market caps are now, used to be that somebody, whether they were perpetrating an actual fraud or one of these intellectual frauds, they were really good if they could take $30 to $50 million off the table. So I'm talking about something that maybe had a 1 billion to 2 billion market cap. The way things are now and the market caps and the liquidity, I think a lot of these guys are pulling down 9 figures in these scams. It is so remunerative. And when we are talking about actual fraud, enforcement is it seems like it's overwhelmed. And when we're talking about this, just the intellectual fraud that violates the spirit of the law, but not the letter, it's just de rigueur. We short, I think some of the companies that we short in that category, the CEO and other senior members of management are probably looking at each other and saying, well, why the fuck did he choose us? Like, what are we doing that these other guys aren't doing? And that's a valid point. Like, everybody's doing it. Everybody is gilding the lily and exaggerating, and nobody's presenting pure information to investors, because if they do, they're going to be punished for it by the market.
That's a good point. And, we were kind of dancing around this, talking to this as we were thinking about this this interview yesterday, and the analogy that I gave you is when you're in a traffic jam on the highway. At some point, you're just like, I kind of want to take the emergency lane, even though I know it's illegal and it's supposed to be for emergencies, but you don't do it because you're following the law. As soon as the first guy does it, someone who is right on the edge will say, you know what, screw it. This guy, he's getting a faster way. I'm going to take the fast way out too. And before you know it, everyone and his brother is taking up that lane. The emergency personnel can't get through, and the whole system breaks down. That's kind of how I'm seeing what's happening as well.
Yeah, I mean that's a great analogy to describe how this corrosion happens. Few people get away with it at the beginning, and then it turns into a flood. And if you want to, actually be nice to some of the people who are following, those cars that are going on the shoulder, I guess in your analogy, I mean they're basically looking at it and saying, well, if I don't do this, I'm disadvantaged. So in the corporate setting, all these other companies against which we compete for capital are manipulating their financials and are playing this game. So, we're saddled with a higher cost of capital if we don't do the same thing. It's just, this is the problem when you let the environment corrode, when you don't insist on accountability. And that's just something that, like, people in the markets in general haven't been insisting upon. And as I said, when you have the situation where a lot of it's legal, I mean, there's no role for the government there. It's really incumbent on investors to insist on pure information. But you see each year in the debt markets, more and more covenant light or covenant less deals get done. And so investors really, they're going in the complete opposite direction, or they're effectively saying, come on, lie to me.
Let me take another step back and talk just from a generic perspective about what that means from a zeitgeist perspective in terms of loss of faith in institutions. Because when I think of the dynamic that you're talking about, this is something that seems to have been playing out over the last week with this whole GameStop thing and Robinhood and so forth, how people are just like, wait a minute, these guys, they're getting away with this stuff. Why aren't you letting us get away with it? And to me, I would say when I zoom out to the financial crisis of 2008. I think of people, losing their homes, people being evicted, living in their cars, losing their life savings, and their families now, 12 years later, saying, we're not going to play that game where we're the patsy and, the big guys get off with, some fines, but no criminal convictions. All of the banks, none of them went under except for Lehman Brothers, and that's it. So, what do you make of that in terms of how you're thinking, just from a philosophical perspective of how we got in the position where we are today?
Well, yeah. The fact that there weren't senior people held accountable. I mean, on one hand, it's like bad judgment is not necessarily a crime. You can argue that there's lots of bad judgment. But then on the other hand, I'm a fan of Jesse Eisinger's book, The Chicken Shit Club, and it's named that way because when Jim Comey took over Southern District of New York when he was the U.S. attorney, he asked, I think, the criminal division attorneys. They had a weekly meeting, and he asked them, okay, how many of you have never lost a case? And almost every hand went up in the room. And he said, my friends and I have a name for you. That you're the Chicken Shit Club, because you're afraid to take hard cases. So we know two things, okay? Well, we know three things. A lot of harm was done, obviously, to billions of people around the globe by the financial crisis, one. Two, there was a lot of just legitimately bad judgment or short-sighted judgment that wasn't criminal conduct. But three, there weren't attempts to prosecute whales here. And it's hard for me to believe, and it's hard for a lot of people to believe, that the failure to even attempt is fair. So yeah, I mean, there a lot of credibility was lost, and I mean, and you lead up to it as well. I mean, you had all of these people, who were PhDs in finance and economics saying, no, derivatives are fine, and derate, they make the system safer and less risky, and leverage, that's okay. You're worried about things, that's an old framework. And guess what? It's never really different this time. And so people who were, I mean, you could be a high school graduate only and keep that one phrase in your mind. It's never actually different, and have known that this was all going to blow up. So really the question a lot of people asked is, well, what the fuck good are all of these PhDs in finance and economics if they can't foresee this? And that's a fair question.
And we still today don't have an answer. And I think all of this is the backdrop to what I would consider a somewhat chaotic week last week, and there's still a certain degree of chaos that's occurring right now. Talk to me about how you're looking at the GME, that's the GameStop, and the AMC debacle last week, both in terms of the market action, but also in terms of the regulatory and the market plumbing behind that created the environment.
Right. So let's start with there was some bad risk management by at least one hedge fund. Okay. Too big. I mean, they know it. I don't think this is kicking them when they're down, but Melvin obviously messed that up. Actually, very smart analysis on the front end of this, understanding the technicals, understanding why it could squeeze. And there was also a legitimate argument about what's GameStop really worth. You had Ryan Cohen from Chewy's take a major stake in it. You had Michael Burry take a stake in it. So there was this view on that side that, hey, this thing has value, it's not done. And then there was the view on the short side that it is done. But so what started as a smart trade by retail, and what's interesting about that is it was a democratization of this squeeze tactic that, I mean, some hedge funds or groups of hedge funds seem to employ from time to time. So retail got hip to it and they squeezed the stock. But then there was this, then when it became clear Melvin is experiencing some major pain. Andrew left of Citron, obviously wasn't loving life at that point. Then there was this bloodlust that came about. And so the narrative there initially was, okay, this is the retail investor saying, we're rebelling against Wall Street. We're tired of Wall Street screwing us. And maybe, look, I don't know the psychology of the people on Wall Street Bets. I mean, I only went to that Reddit page for the first time in my life 2 weeks ago. But I don't entirely buy the narrative. I think we are all angry. I mean, just especially because of COVID, like there's just so much anger. And really, I think a lot of us do want to break something if given the opportunity. And so I think that that's kind of what took over. But then it seems like it actually stopped being a retail trade so much, and it was more institutional. So there are some people who posted from last Tuesday and Wednesday. They show that Robinhood was net sellers of GME as opposed to buyers, yet the stock went up. So that was indicative that likely this is institutional. And we see now the stories of the institutions that have made some really good money on what happened in GME and also AMC. From a regulatory standpoint, I didn't really see much, but I do think there is, maybe if there's going to be focus on some people. I mean, there were some high-profile people like Chamath, Dave Portnoy, who exhorted people to go into this. I don't know that there was anything wrong with that, but I could expect them to look. They might have some questions to answer just because there's so much political heat around this now, and that's the part that I don't know is kind of problematic because I've seen a number of politicians tweeting or read their statements indicating they're really upset and want to do something about this. But not only do they not understand what's going on, I don't even think they know what this is. Like, what's the problematic part here? A hedge fund getting blown up. None of the, I'm sure none of these politicians will say that's problematic. The fact that a bunch of people made money on the way up, it's hard to go after that. The fact that they're losing money on the way down, maybe, but it's going to be a political clusterfuck, unfortunately.
What do you think of just from the market plumbing perspective? I think I saw a note where they were a source close to the National Securities Clearing Corporation said there were no negotiations. That at 7 a.m. Eastern time, which is 4 p.m. or 4 a.m. your time, basically they decided, you know what, the vol in these names is so high, we're going to ask these guys to post up a ridiculous amount of collateral, and that's what turned the whole thing around, and it metastasized into a massive own goal for the Robinhood in particular. How do you see that, and what's the solve for that problem?
Well, again, we're talking narratives. That's a good narrative, but I don't think that's accurate. So again, go back to number one, retail looks like they were net selling even prior to that. So it would have been more institutional getting burned on that. But it wasn't only Robinhood. Okay, so if you take a step back, DTCC, they didn't know how to manage this risk as a clearing corp because of T+2 settlement. And because, like you said, the vol blew out. I mean, vol on some of these options that I saw was 1,000%. One of our counterparties, which also restricted and prohibited adding to those names or initiating new positions in those names, and is not Robinhood, it's an institutional firm. One of them said, yeah, our risk models, when you get a stock with 500% implied volatility, like our models can't process that. So at DTCC, they're freaking out because they don't know how to deal with this. They did what they needed to do. And it wasn't only Robinhood. We had at least three of our counterparties put halts on that trading because they don't want to tie up capital posting collateral for this either. So it became a victim of its own success, this trade, in a way. The other thing that happened as well, and I'm not sure that it's accurate to say, well, that's why the trade fell apart. But you also had these options dealers who finally said, hey, I'm not going to lose any more money on the gamma here. They jacked up their prices at which they were selling these call options. So suddenly these call options became incredibly cost prohibitive. So if you're a retail punter thinking like, okay, I'm going to buy these out of the money calls and try to squeeze stuff higher, well, like $50 for a call that's going to expire in a week and a half and is at the money, it's like a lot to punt on it. So I think that it also ran headlong into that. But there's one other comment that I want to make, and this is something I was thinking about last night. I really know very little about the plumbing, but since this happens, you have all these people, even some market commentators, who write frequently, whose opinions I respect. They've talked about our antiquated settlement system, and other people, of course, are like, barfing out like blockchain. If it's on the blockchain, it'll, magically be better. Here's the thing. It works. The settlement system works. And when you think about how much, it's in the trillions of dollars a day, I think, are traded probably, or close to it, especially when stuff gets really active. The fact that we're able, DTCC is able to keep track of who had these shares, for these few seconds, and then who owned them for that microsecond, and then who bought them and is still holding them, and reconcile all of this. That's an incredibly complex system. So this call for like, oh, we need to rip this stuff out and replace it with blockchain or something modern. It's like, I don't know, man. Like there could be a lot of unintended consequences from that because, like I said, this system works. And if the cost of it working when something goes parabolic is brokers having to post more collateral, I would rather take that than a system that might break down. And if the settlement system underlying the U.S. markets ever broke down and they couldn't figure out who owned what or owed what, holy shit. Like that would be the calamity.
Yeah, very well said. And from your perspective, in terms of this GME GameStop thing, my question to you, as someone who's looking at short selling, what kind of size of company are you talking about? You earlier talked about these billion-dollar companies with who were taking 30 or 40 intellectual fraud or actually outright fraud. Where are we now in terms of where it pays? Because obviously, on the one hand, risk management wise, it may not have been a good deal for Melvin here, but if you manage your risk, could you take on a company of this size? Where are you looking?
I mean, our sweet spot has generally been in the 2 to 5 billion market cap range, but now, especially when you look at some of these SPACs that are complete jokes, I mean, these things are coming in at 7, 8 billion in market cap. And look, sometimes we have been higher than that, but when we look at how to size a position, I mean, we look at the trading volume, so the average daily volume, and you can't be too large relative to the average daily volume. I think Melvin was, if I remember correctly, they were about 6 days average volume at one point. And I say at one point because the average volume, skyrocketed as the stock started going up. But going into that, I mean, that's, you don't ever want to be that big because you figure if you're trading out at 20% of volume, all right, like first of all, if you go to a broker and say, okay, buy blah shares, max, limit this, max 20% of volume, all right, all the HFTs are going to sniff that out and know that you're a buyer, if you're doing 20%. So doing 20%, you're going to probably move the stock some. I mean, disadvantage yourself because the HFTs are trading in front of you, but it's doable. So if you were a day of average volume in your short, you would take about 5 days, a typical day to get out of that short, and you would be losing some money pushing it. So if you think that you're 6 days, I mean, man, you're just way too big. So we look at the average daily volume, and then also we look at the utilization of the borrow. I mean, we want to know. And another thing when we're dealing with our counterparties is we want to understand that borrow. So we'll ask them, is this stable, or or are they kind of scrapping it together from different lenders? And we certainly have to factor that into our sizing decisions, is the stability of the borrow.
In terms of companies that you're looking for, the first thing that comes to mind is this whole John Kenneth Galbraith concept of the bezel. I want to go back to what you were saying about where we are systemically. John Kenneth Galbraith, he was saying, this is the great crash of 29. He was saying that there's always, at least now you're saying also intellectually, but just generically speaking, a embezzlement that's happening. It's so-called the bezel, and the bezel increase. We don't see the bezel; it's there. It has to be uncovered. So, my general question is that when the tide goes out, obviously that's when you see the bezel. But there's a process associated with the tide going out, so you can see the bezel. Where are we in terms of that going out, and what's your process in terms of making that known?
Well, where we are is difficult to say because you can look at lots of different factors. So even late last year, before this latest insanity, I was saying that retail investor behavior and attitude reminds me a lot of 1999. I mean, such a speculative mania. So you wonder, can that continue? Well, on the other hand, we're not going to see monetary tightening anytime soon. We're going to see more stimulus, so probably more stimmies thrown into the Robinhood accounts, which can push stuff higher. But on the other hand, the markets are also much more fragile. And this is something that I think really needs to get a lot more discussion. And that is the single biggest factor that makes the markets much more fragile today than they used to be in 99, 2000 is the prevalence of passive investing. I'm not against passive investing per se, but when passive gets to be such a large part of the market, it's effectively, shrinking the float. And so it replaces, passive squeezes out active managers. So if here are the outstanding shares, here's the float. Well, now if passive is this and it's continuing to get flows, it's going to pay up each day in order to buy stock from a decreasing number of active managers. So or active investors. So if active investors end up being this at the end of some period, when there are outflows from passive and passive must sell, who is left to buy, when there's this wall of shares that must be sold? And that's what makes markets much more fragile. And I think that was the dynamic that played out in March of last year in the equity markets, was all of this supply, because we were in this massive risk off moment, passive had outflows, and there's just not enough active left. So that, there's an equilibrium, or maybe there's a tipping point, at which passive becomes too prevalent. And that's when we get a market that's really driven more by technical analysis than fundamental analysis. That's more about questions such as, when will this company get added to what index, and how popular are those index tracking funds, versus how well will this company grow it, how well will it take the capital that it's raised and grow its business and create value. And that's a problem. Like at this point, the markets aren't doing what they're here for.
But doesn't that create a problem for you, therefore, when we're talking about companies have difficulties in terms of their intellectual fraud, really the ability to uncover that fraud, either through your research, getting people to start thinking about the questions that they have, or other mechanisms, that's short-circuited because you have this massive amount of momentum trading that's happening purely from a technical basis.
Yeah, I mean, look, one of the adjustments we have to make is we have to stay away from companies that have a significant amount of passive in the shareholder base. So good example is a biotech company called Inovio. We were short that earlier last year. We didn't publish a report. I put out a series of tweets on it, though. This is a company that's been around, I think, about 35 years, between 30 and 35 years, has commercialized all of zero. And every time there's a new illness that captures the public's imagination, Ebola, Zika, COVID, they announced, that they're working on the cure or the vaccine. And again, they've done fuck all, for all these years. So we were short it last year because we said, hey, they put out their COVID hype release, but the thing is, they're in litigation with their contract manufacturer. Their contract manufacturer is not going to make this for them, and Inovio's claiming in court, well, Your Honor, you should tear up the IPR protections here because we cannot have this manufactured anywhere else because they're the ones with the technology. And so we thought, okay, well, that should completely nullify, any hope that these guys are going to be like anywhere in this COVID race. Of course, that's putting aside the whole question of how profitable will a COVID vaccine actually be. But but I look at it today. The stock went up after we, shorted it, of course, came back down. But now I pulled up the shareholder table earlier today, and as of the end of September, I hadn't caught this, but the top three holders: BlackRock, Vanguard, State Street. What the fuck? Like, that's what's holding the stock up right now. It's just a joke of a biotech company. But if we really want to talk dysfunction and jokes, biotech has a whole universe of companies that are never going to do anything other than sell stock and have managements that sell stock. But yeah, that's kind of, that's one of the things we have to avoid. That we would not short Inovio now with that much passive ownership at the top of the shareholder table.
Right. Now, I was talking to you before we got onto this. I wanted you to take me through American Tower, because I know that you mentioned that before, and you were saying that, this is a company, we did the research. Definitely, I stand behind the research, but hey, it didn't fall the way that we wanted to. Maybe an exposition like that will sort of give the viewers understanding of, what the intricacies are of when do you get out of these positions?
Yeah, well, American Tower, that was the 2013 campaign that we began. And I mean, yeah, it was the best of times. It was the worst of times. I used to say that that was the best research we'd ever done. And the reason for that was, I mean, we did real hard hitting on the ground research in Brazil, in Colombia, in India, in Tanzania, in Germany. I mean, I thought we unraveled that the whole secret to their, international growth strategy was really just running a levered carry trade, borrowing in a cheap currency, USD, and going long fixed assets in Tanzania. I mean, and also Ghana. I mean, the Ghanaian sovereign at that time was yielding over 20%. So we're looking at it and be like, dude, these IRRs, okay, they're not that great. Like you could get the same IRRs or higher by going long the local sovereign. And by the way, it's not a fixed asset that, if it gets destroyed or expropriated, you're screwed. So, I thought that was one of the things that we did that was really impressive. The other thing, though, that I really, to me, the thing that was really profound was there was a problem. They had bought a tower portfolio in Brazil from a seller called Site Sharing. Now, they had not disclosed the name of the seller. We figured that out. That transaction, from memory here, I think they said that they paid 500 million US for that transaction, the tower portfolio. The real price that was received by the seller was only about 250 million. So there was 250 million where did that go? And I mean, that, that is fraud in the financial statements. But, a few things went wrong with that campaign. We were massively front run on that. That's one of the risks in our business is security leaks. And so we had at that time a major security leak. And I should have seen it going into the release because there was just a huge amount of short dated put buying. And we were not the ones buying those puts. I was just so focused on the research. And, one of the comments that I've been making a lot to media lately about GameStop is talking about how we hired a full-time trader just this past year because of how the markets have become. I mean, back in 2013, we just really were not sophisticated with our trading. So we were front run by people who had misappropriated our information and that we were going to be doing this. And so they had a bunch of puts outstanding. As soon as we went public with the report, the stock dipped for a moment and then came right back as they were selling the puts, and market makers are taking off the delta, putting a floor under it. Now, why is that important to how things play out? If the shareholders aren't screaming at the end of day one, it's a lot easier for companies to get through this without bringing in investigators and without the SEC also taking a look. Like the SEC only cares when something goes wrong with the stock generally. So that helped them out as well. But one of the other things that I learned from that experience and some others, well, there were two other things there. I mean, we took everything that we, had gathered about that company, including critiques of the tower model, outside of the international, but just saying, hey, the tower is not unassailable. These are technological threats. And we put it out there. And that was a mistake. I mean, we threw too many other arguments by kitchen sinking it. We lost credibility, I think, with investors who had different views on the state of the tower, and they weren't going to take the other arguments as seriously. So that was a learning experience for us in that regard. But the other thing is, American Tower was priced for perfection, and that was part of our view. We weren't saying it was the worst company ever. We're saying it's perceived as perfect. It's really actually pretty mediocre and hairy, but we're not saying it's awful. And I looking back, most of what we do is take companies that are perceived as mediocre and have some hair, and we say no, they're actually awful. But I think when we say companies that are perceived as perfect but are really mediocre and hairy, those theses just don't really move the needle. Now, of course, the best in my business is a Sino-Forest or Burford Capital, which was one in the UK, where it's perceived to be, a great company, and it's really an awful company. So, but I mean, those don't come along every day. But yeah, I mean, 3 years into being an activist short seller, American Tower was a learning experience for us, and I really, it's a shame that nobody ever found the $250 million. It's wish some of it had landed in my lap. That didn't happen.
Well, I want to end this because I told you before that I wasn't going to talk about Zero's TV, but actually I do want to talk about it because what it made you said one or two things there that made me think about it. You were talking about the SEC doesn't care unless bad things happen, and so what I was thinking about is I was thinking about your process and how that works because you're only one piece of the puzzle in terms of uncovering that actually this company says that it's incredible. People think it's incredible, but actually it's not. And there's a whole process by which that happens, where you're sort of the spearhead to the discovery of that. Where does Zero's TV, which by the way my colleagues at RVCS are helping you with, where does that land you in terms of making that process happen? And before you even answer, maybe you can talk a little bit about who else needs to be involved in terms of uncovering things in order for a intellectual or actual financial fraud to be uncovered.
Okay, so let me talk first about just some of the process. I mean, it's not rocket science, but it's just a lot of time and effort. So, for example, what we did, if we take American Tower, we just made a chart of the price per tower that American Tower was paying in different countries, and that one portfolio acquisition really jumped. I mean, it was just an outlier. So, okay, from whom did they acquire that? Company didn't disclose it. I think we had a conversation with IR and they didn't or wouldn't say. Well, so then we hired a lawyer in Brazil, or engaged a lawyer in Brazil, and also some investigators, and they made inquiries at Anatel. I think that's the name of the Brazilian regulator. Oh yeah, that was this company called Site Sharing. All right, pull up, we can get the financials. I mean, a lot of jurisdictions around the world, even privately owned companies are required to file financials and shareholder registries. So we pulled the financials. We're like, how the hell was this thing, $500 million or whatever it was. And so then we had our lawyer and investigators asking around at Anatel, and we talked to people in the industry. And it was the acquisition price was done on they talk about price per tower. So I think the issue was, where this got doubled was it was the price per tower that everybody believed Site Sharing received, if I remember correctly, was 600,000 real per tower. But what was reported was 600,000 USD per tower. So that was how that money was peeled off, was changing real to dollars. So we had conversations with people in the industry, and everybody's saying like, oh yeah, 600,000 real. Everybody knows that. Some people were aware that it had been reported differently. And they said, yeah, I don't know what the deal is there. Others were really surprised to hear that. We then had somebody go undercover, and he posed as a potential private equity investor, met with the former controlling shareholder of Site Sharing, and got the guy talking about the transaction. He's like, yeah, it was 600,000 real. Yeah, I know they reported $600,000, and then he made some comment like, I don't know, maybe some, investigators can go find where that money went. So we had that. And then in the rest, for a lot of the rest of the work, we were talking to local, people around the world, where American Tower had gone in those markets, understanding how the tower business worked. And so, one of the things that we also unearthed about American Tower was these agreements had a finite length, and that likely when they were renewed, there was going to be a real decrease in the rents. And so there was like a cliff for, these great IRRs that they were generating. And so those were details that we unearthed. And and we were able to get real unit level economics by hiring lawyers and investigators locally to understand what the markets were. And we built these models that for each market that just showed that these unit economics were, they weren't really that great, and they had real sunsets to them. So that's how we do it. A lot of it's just pulling these local filings, talking to people locally in the industry, and going from there.
And what's the end game in terms of how does that work? That's what I'm most interested in. This, obviously the stock has some reaction to the portfolio, but to me, the understanding is that the way it really works is that it then therefore causes a reassessment mentally of a whole different host of people about that company and what they've been doing.
So great question. So the way that I think of short activism is, what we're doing is we take most of what we know and we put it out there up front. So it's not like long side activism, which really has a scenario analysis to it, and it's an ongoing chess match, and it's a finesse game. Short activism really is a power game, and we're trying to knock over as many dominoes as we can in the first instance. We have some ammunition, and especially if the company comes back and lies, that's very helpful usually to our cause, because we can, then turn that around on them. But the goal is to create a lot of scrutiny on the company from investors, from outside board members, from regulators, from the auditor, counterparties maybe. And with all this scrutiny, it creates a highly pressurized environment in the company. Now, here's where we're at a disadvantage, because from the outside, we can't see whether things are breaking and what is breaking. But if we succeed, it's because this pressurized environment is causing things to break. And so that's when you get CEO or CFO resignation, or a regulatory investigation, back when those, actually meant something, or auditors resigning and things, so that's how we succeed over the medium to long term. But it's very difficult to see from the outside whether we're succeeding. There have been a number of times when companies have succeeded in yoking their stock prices back up, and we're thinking like, fuck. And then it's like they report. And the big thing that often happens is they have to dial back the aggressive behavior, especially if it's one of the legal frauds, the intellectually fraudulent. They dial back the aggressive behavior, and they just can't put the numbers up that they were supposed to put up. And so then that's when we win. And we win, I feel like we've historically won over the long term most of the time, but there are sometimes we really get our asses kicked hard, like AMT. So if I knew at the beginning which ones we'd win and which ones we wouldn't, we would only do winners, of course. But that's how it goes.
Very, very informative conversation, Carson. I really appreciate your taking the time to talk to us about GME and also about short selling in general. So hats off to you, and thanks again.
Cool. Thanks a lot, Ed. Enjoyed it.